All right. How you feeling, Alp? You ready to get going?
I am ready to roll.
Excellent. Excellent. Well, thanks everybody for joining us. So we want to be timely here. I've got 11 o'clock on the dot here on my watch. So we'll go ahead and get started. I know some other folks are still signing on, but we want to keep this definitely to under an hour, hopefully a little less, and definitely have time for questions as we go forward. So just a few quick items to begin. As always, thanks for joining us and welcome back to another year of our annual monthly workshop series. And we are excited to kick off the year with our latest insights on the markets and the economy. Not much going on these days, so just kidding. We've got a lot of material to cover, so we're clearly going to be scratching the surface, but I know we're going to touch on a lot of really interesting and insightful items with some great charts as always. And so if anybody doesn't know, my name is Jason Dahl. I'm a certified financial planner and the director of financial planning services at AFS Financial Group. With me today, still remotely, is my colleague, Alp Adebeck. Alp is the founder and managing partner of AFS. And also, I know we have a number of folks tuning in from what we call the 401k side. So it's just as a quick reminder, we at AFS Financial Group operate as a separate entity from the AFS 401k Retirement Services team, but we often collaborate, especially when it comes to our financial wellness programs and presentations and workshops like this. And as a reminder, please ask questions at any time during today's session. We will keep everybody on mute. So to ask questions, we ask that you please type them in to the Q&A link. Should see that on your screen as a part of kind of one of the pop-up choices. And that you click that Q&A link, it opens a little dialog box. You can type in a question. Feel free to fire away questions at any time. No guarantee that we're going to know the answer to every question. We will certainly give you our best response, and if we need to follow up, we will follow up. That's not uncommon. And I know we are recording this, so part of our follow-up, we will send a link to the recording and any other, any additional insights or comments from questions or otherwise. And I will say that one of our favorite questions is, can I schedule a time to speak with you, Jason or Alp? And I want to encourage you to directly follow up with us after the webinar if you have further questions or would like to schedule a time to review a few things over Zoom or the phone. We truly do. We love what we do. And honestly, the best part of what we do is connecting with people and helping them solve personal financial planning puzzles. So please don't hesitate to reach out.
And I would say that our office is probably close to being back open. We actually finished renovating and got it inspected. We altered a few things in the office, so we are capable of coming back in if somebody wants a face-to-face.
Absolutely. Yeah, it's a new hybrid kind of world. All right, and just a quick disclaimer. All right, this presentation isn't meant to be, an endorsement or specific recommendation for any particular investments, right? This is for educational purposes only. And recognizing that this is being recorded, and if somebody is listening to this in the future on a recording, obviously all of this is dated material, right? We're talking a lot of numbers, and we'll identify, sort of the as of dates for a lot of the data that we're going through. All right, so let's get rolling here. And this is, I think, perhaps one of Alp and my favorite quotes. And honestly, when we were thinking about, kind of the traditional agenda slide for today's presentation, both of us, I think, came to this quote. And we thought, boy, this kind of summarizes the agenda in a lot of ways. And so I'm going to commit that, presentation send and read the slide. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. And this came from Sir John Templeton. Some of you may be familiar with his funds that still exist. But we really thought, gosh, doesn't this kind of summarize the cycle the markets have been going through for a number of years, right? I mean, Alp, would you agree? That pessimism, there's always fits and starts of pessimism, but gosh, you could go many years back, right, to even back to the financial crisis, right? That was true pessimism in the markets, and for a number of years coming out of the financial crisis, there was a lot of skepticism, right? I remember us talking to a lot of folks that well, is it real? All right, is this recovery real? And then it kind of grew as people got more optimistic and comfortable. Obviously, there was the markets took a hit with coronavirus, right? That was definitely a bout of pessimism, right? And we saw a similar kind of a response and feeling to the markets that, okay, is this recovery for real coming out of March of 2020? And so I think, Alp, you're going to kind of launch in here. Talk to us a little bit about the euphoria.
Sure. And so we actually had a little bit of a euphoric stage in 2018. I know people forget about some of those things because we recovered, but we had a period in 2018 that there was a number of stocks that basically got in front of themselves. They just really did tremendous for a while, and people were starting to get very aggressive in the markets. Post-pandemic, we had the same thing happen. So I'll say in the early stages of the pandemic recovery, we started seeing, I guess, that new buzzword, the meme stocks, the GameStops, the AMCs that just went through the roof, and also throughout the stay-at-home stocks. There's Carvana, DraftKings, Moderna, Peloton, Roku, and there's just, I'll say probably 50 to 75 well-known names there that their stocks went through the roof, and it was complete euphoria. There was a fund family, still is, ARK funds run by Cathie Wood. She had 5 exchange traded funds that I think in 2020 were up over 100%. And I think right now they are, so we've also said there's actually what we call a stealth bear market that was actually happening. Most of those peaked around January, February of 2021, those euphoric runs in the market, and have rolled over considerably from the peaks. The Cathie Wood ARK funds, they're generally down about, despite a good market for the rest of 2021, they were selling off really hard, rolling over, and today I think they're down 50, 60, 65%. The names GameStop, AMC, Carvana, DraftKings, Moderna, Peloton, Roku, they're all down from 60 to 84% from their highs. So, typically that term bear market is when something is down 20%. A correction is generally between 10 and 20%. So there's parts of this market that went through this euphoric stage and have literally rolled over. We have very little exposure there, but it's been fascinating. So this is probably one of our long-term slides that we show on every update, and for investment committees for 401k plans, we always go through this. This is the S&P 500 index at inflection points, and the term inflection points not really meant to scare you, but to go over the slide on the far left, you'll see March 24th of 2000. You'll see, so that's basically when the tech bubble rolled over. The forward price to earnings ratio of the market was at 25.2. And you determine a PE by taking a price of a stock. So if a stock's $100 a share and it earns $5 a share in profit, divide the 5 into 100, that would give you a PE of 20. The higher the PE is, the more expensive a stock, or in this case, an index is. So the forward PE, so it's projected earnings for the next 12 months, was 25.2 at that point. So market was actually considered really expensive. You see the big sell-off there, bear market down 49%, really a slow recovery going into the credit crisis. The market on October 9th, 2007 actually wasn't that expensive, selling at a forward PE of 15.1. Come back down, March 9th, 2009, really cheap. Warren Buffett, I think, took out an op-ed in the New York Times probably late 2008, telling people that the market was cheap. He was buying equities, and you can see that long-term move up. And then you can see basically the sell-off that we had in the pandemic, really quick downturn. And one of the things that we've pointed out in prior market updates is you see this long-term trend line, that 401%. You can see its direction, and basically it started going vertical in the recovery. So it started a new trend line, and that actually worried us. I know in meetings with clients, and I'll say in investment committee meetings with 401k plans, we basically said our expectation is at some point we think when something goes vertical, it usually comes back down to the trend line. And so I think we're experiencing that right now. So the forward P in the market right now on December 31st, 21.2. And I actually have an updated number on that. That's actually come down since December 31st. The forward price to earnings ratio of the market is around 19.6. And the next slide will put that into perspective. This is the 25-year history of the forward PE. And so you can see on the left side of the screen, that's the tech bubble when it was actually getting expensive. And you can see going down to the credit crisis, how cheap it was. And right in the middle, you'll see the 25-year average, 16.83. And as I said, we moved up to basically 21. And now, as I said, back down to 19.6. If you see me look to different screens, I've got three different screens running in front of me with different data on it.
So with the recent sell-off since the start of the year, we are now below that first standard deviation.
That is correct. And so some people will argue that the market should be a lot more highly valued than the 25-year average in our current low interest rate environment. And what I mean by that is if you went back to 2000, there was alternatives to the market back then. You could earn 5% in money markets, CDs, bonds. You could probably get 5.5%, 6.5%, treasury bonds. They were just yielding really well. So there was alternatives to the market. Because in a low interest rate environment, there really have been no alternatives. Even the grizzled vets of the market believe that we should have been priced higher. So while the market, I'll say, is expensive, well, a probably better way of wording it, it's no longer cheap in any way, shape, or form. It's not outrageously expensive when you factor in the environment that we're basically in, right. Still a low interest rate environment.
For all you acronym lovers out there, some people like to call it TINA. There is no alternative right now, to Alp's point of you just can't earn really anything just by keeping money in the bank.
And as you know, we're probably about to start a rising interest rate environment, but the odds are it's not going to go up anywhere near to where it's going to be really meaningful for the fixed income. So this is really a fascinating slide, and this was really driven by the large cap growth names, and you can read them on the bottom. Basically, yes. Microsoft, Apple, Amazon, Tesla, Google, NVIDIA, Facebook, Berkshire, and actually not large cap growth there, JP Morgan, J&J. So the first 7 names are large cap growth names, but the PE ratios of the top 10 stocks in the S&P 500, that top line, you can see on the far left, basically going to the tech bubble, got really expensive. And basically right now in this market, they got really expensive. So the PE ratio of the top 10 stocks, 33.2, average, 19.8. The remaining stocks, 15.7. So no question that when you see these types of gaps, and you see like basically, there's a long period where the two were trending together and we separated again on the far right. Typically, you see it come back down to the trend line. And so on the top right, the weight of the top 10 stocks in the S&P 500, this is a percent of market capitalization. On December 31st, that number is 30.5%. And I have to see if I can pull that up quickly. Here we are. I have to slide through a bunch. That's actually dropped to 29.3% right now. And an interesting way of looking at that is 10 stocks out of the S&P 500. So there's generally 500 stocks in the S&P 500. And I say generally because there are times there's 503, 498 for a variety of different reasons. They do make changes to it. The top 10 stocks basically are 30% of the total S&P 500. That means 490, the 490 next largest companies in the US only represent 70%. So you see it got very top heavy. Interestingly enough, on the bottom right, these are very profitable companies though, and we've seen a little bit of a pullback there on some of it, but it is to some degree, it was justified, and the earnings growth there basically was substantial. So if you look at how much Apple was earning on a quarterly basis, or Facebook or Google, at times we joke that they were literally printing money. Same thing with Microsoft.
An important distinction from the tech bubble, right? In 98, 99, 2000, where these companies now, there's some justification to its valuation. You might say you might still argue, and many people do, it's rich, but a lot of the companies in the tech bubble, they were valued just because they had a URL.
Yeah, so this next slide's it's also just a continuation on where we are in terms of valuation. So we're sticking with that theme for a while. And if you look at the top right, this is the current price to earnings ratio of these various asset classes. So we have the US market broken down into large cap, mid cap, small cap, value stocks, which are, I'll call it the blue chip dividend paying stocks, blend, which is core stocks kind of somewhere in the middle, and the growth stocks, again, the Amazons, the Apples, the Microsofts of the world. So large cap, mid cap, small cap, fairly self-explanatory. Really big companies, medium-sized companies, and small companies. Large cap growth, current PE 30.6, the 20-year average 18.5. The bottom right puts that into percentage terms. So basically selling 65% above the 20-year average. And you can see the same thing on mid caps, about 65%, small caps 21% above it. And that now those numbers are 45%, 40%, and 4%. So small caps have taken a decent beating. Where it's reasonably priced on the value stocks. And so the distinction I'll say here is the market action for the last 5 or 6 years really has been driven by the growth stocks. The value stocks have underperformed in relation to the growth stocks, but the value stocks actually are very reasonably priced, where if you look at their current PE versus the 20-year average and then factor in what I mentioned earlier, that we're in a low interest rate environment, basically selling at 15% premium, 8% premium, and small cap value is actually selling at a discount. And right now I'm showing small cap value at 88%. So basically a 12% discount to the long-term average. Things that I think.
So Al, sorry to interrupt you there. Had a question come in, and so do you think it is if it were right at 100%, right? If it were right at its 25-year average, that's where it quote unquote should be. If it's above that, is it expensive? It's below that, it's cheap. Like where do we kind of typically draw that line?
Sure. I think if we were in, and I don't even know what normal is anymore when it comes to interest rates. Years ago, some of the smartest people in the world when it comes to bond investing, one guy, Bill Gross, he used to run a fund called PIMCO Total Return. He felt when mortgages dip below 5%, and this guy really is brilliant. He said, I think that's going to be the theoretical floor. I don't know why anybody would give anybody money for 30 years for less than 5%. And so they were very wrong on that. And so the question is, where will interest rates be in 5 or 10 years? Will we ever normalize? And some people think normalize on the 10-year treasury is 4%. I don't believe that. I think it's probably in the world we're in now might be closer to 2%. So I'm going to say, depending on where interest rates go and what is normal, that's how you have to factor in what's expensive. So I think if we stay down at 2%, and the 20-year average will kind of, keep in mind, as we stay at these higher valuation levels, it will actually, it'll bring down the average as it is, as we cycle in more higher years. But on a shorter term basis, I felt that maybe like a 115, 120 would be reasonable in this low interest rate environment, if that's a fair way of answering that.
Yeah, it's fair to say it's a moving target, right? Given conditions and
absolutely.
Yep,
and I'll say on the left side of the screen, I just want to bring up one slide. So since the market peaked in, so bottom left, since the market peak of February 2020, so that is before the pandemic. So the market wasn't cheap at that point. And this is something that we find fascinating. You can see how much the market jumped since that point. And again, driven by the growth names, and that kind of is that signal of that euphoric stage where for it to have gone up 61% in that short period of time, I think it's safe to say that that really is a fairly good definition of euphoria, that we had already had a good market cycle prior to February 2020, and for it to have gone up that much more kind of just doesn't make sense.
Yeah, I mean, I think that's a good point to emphasize, right? Like, again, it's up 61% from the point prior to the pandemic sell-off, right? And here you see from the market low, which was in March of 2020, it's up 136%, right?
This is Jason's favorite slide coming up. And when you see me hold this can, this is not alcohol. I'm not that worried about the market. It's just club soda.
Thanks for clarifying, Alp.
Right.
So Alp and I, we both like this slide, but perhaps it is my favorite slide, and just because I think it's always a tremendous reminder, right, of the normal kind of market movements. And so just a quick refresher, many of you who've been on these calls with us before are familiar here, but just what we're looking at, essentially goes back to 1980, and again, it's just focusing on the S&P 500, and so year by year, all the way through 2021, the gray bar chart represents what the S&P 500 finished each year. Okay, so in 1980, finished the year up 26%. 1981, down 10%, right? Okay, so you see that. You can see that it was up many more years than it was down. In fact, it was positive in 32 of the 42 years. And then where I think it gets really interesting is you overlay the red dots, okay? And the red dots represent the largest intra-year drop or largest intra-year decline, okay? Right, so in 1980, while it finished the year up 26%, at one point during the year, it had a 17% drop. You come across here and you see, oh, every single year there's a red dot, right? And in some years there's some pretty significant red dots, right? Some pretty low numbers, right? You get here to 2008. At one point during the year, it was down 49%, finished the year down 38. 2009 started the year down 28%, had a strong recovery, finished the year up 23%, right? So there's some pretty radical swings in some years. And if we come all the way over here to the right, obviously in 2020, you had the February-March timeframe that we're talking about, that sell-off, tremendous recovery. 2021 was kind of an unusual year. I think, if you just kind of a simple scanning across that screen, you'll see, oh, the largest drawdown was only 5%, right? And in fact, we've had a few of these sort of calm years in recent years, right? Where largest drawdown only 5, only 7, only 3, right? Mixed in with a few big drops in there, but being only down 5% last year, again, kind of to the theme of that little bit of that complacency, or talking about that euphoria feeling, that optimism in the markets, that it doesn't always just go up, right? It's normal, it's natural, it's welcome in some respects, right, to have some washouts, right? And we're experiencing a little bit of that right now to start the year.
And I'll say that only going down 5%, I think one of the things that has actually happened a lot in recent years, and I think the pandemic have kind of destroyed it for a short term, but anytime we had any type of minor dips in the market, and there's actually supposedly $3-4 trillion sitting on the sidelines, there's been a buy the dip mentality. And so whenever it went down 2, 3, 4%, money was coming in off the sidelines and putting it into, coming from a short-term bucket, going into a long-term bucket. So this time, as we've sold off and pierced through it, that's when you saw people just back off and not buy the dip for now.
Yep. All right. So this slide, again, we're big fans of trend lines. We're going to get into a lot of trend lines here in the next handful of slides, but this is historical long-term trend and the real numbers for real GDP, right? So gross domestic product here in the U.S. So now taking a step away from kind of the markets, the S&P 500, now looking at the economy, right? And so you can see the real number here with the solid line. Obviously, a big hit with the pandemic in 2020. Strong recovery, right, for a variety of reasons, which we're going to touch on. But the trend line is the blue dot, right? And so a couple comments, observations that we make is, we're getting close to back to that trend line, which is, kind of the initial goal, right? As an economy, we want to get back to that level, but also a recognition that a lot of people talk about this sort of 3%, 3.5% GDP growth target. And the reality is, historically, it's been for a while now well below that, right? That average, that sort of trend growth has been about 2%. And you look under different administrations, different years, a lot of that has been from spending, right? Government spending. and we're going to touch on that some more too. But right, so the first component is we want to get back to that trend line and hopefully, right, continue to grow GDP without necessarily being dependent on fiscal spending, fiscal policy, or monetary policy that we're going to dive into more. But and then here on the right-hand side, this is such a great reminder of what are the drivers of GDP in our country. And you can see it's I'm going to round this up to 69%. It's consumer spending, right? It's just you and I and all of us just buying stuff, right? And that truly is the primary driver of our economy. And when you think about it, right, the stimulus, right, coming out of the pandemic, where it's most effective is getting it in the hands of people who are going to spend it, right? And generally speaking, folks at the lower ends of the income and wealth spectrum in our country, they spend a higher percentage of every dollar that comes in. And so just purely from a perspective of how do we get the economy going again, get money in the hands of people that are going to spend it, who need it and are going to spend it. And so that's a tremendous reminder of sort of what really does drive our economy. And then here, obviously, something that's been a key variable to this whole recovery, right, is reopening of the economy. And reopening of the economy in a lot of respects, obviously, has been tied to the virus and getting folks vaccinated. The chart on the left, you'll see here, fatalities with confirmed cases, right? So the blue line is confirmed cases. And I mean, I'm not a doctor, I'm not a scientist, but there is some comfort in knowing that despite this spike up in confirmed cases, right, which is scary, right, seeing a lot of folks having confirmed cases, that we did not see obviously a corresponding spike up in fatalities, right? So I think that's somewhat refreshing, encouraging. And then on the right hand side, I think this is really interesting, right? So the blue represents sort of the estimated folks who've been just infected only by the virus. The gray is both infected and been vaccinated. And the blue is only been vaccinated but not been infected, right? I mean, I'm sure on this call there's a mix of all of us in that perhaps. But maybe, again, I'm not a scientist, this combination, we're getting to that so-called herd immunity, and we'll sort of see how that can help, again, reopening of the economy.
So this is going to be like like a pretty big dose of cold water. So this is federal finances, and we always scratch our head on this, that when will this matter? And it's just our deficit and our cumulative net debt, so deficit annually. So this is the 2022 federal budget. And as you know, they have a fiscal year that goes from October 1st through September 30th. So projected this year, deficit spending without any additional stimulus programs going in, we're talking about almost $1.2 trillion of deficit spending. And what is really scary, so this slide changed, I think, in the fourth quarter of 2021. So the prior slide, which had last year's budget on it, it was over $3 trillion of deficit spending. Again, granted, a lot of it pandemic related, but we've spent an enormous amount of money. And the question is, when will it matter? So on the bottom right, you can see federal net debt as a percentage of GDP. And you can see basically World War II time period, big spike up. And maybe you could argue the pandemic is like a new war, but we actually recovered after World War II. We were respectful of deficit spending and really brought it down to very low levels. And then basically from about 2008, think of the credit crisis, we spent a lot of money. And, my guess is just like this time here, and we'll expand on this a little bit, but we've kind of overspent and probably a lot of very inefficient. So if you see where we are right now, we're basically at World War II levels, and the forecast for a fairly long period of time is that it's going to go even higher. And I'll remind you, when Greece was having its debt troubles, I don't know, 6, 7, 8 years ago, I
Seems
don't
like
exactly.
a lifetime ago. No.
Yeah, people were making fun of their country of just how much debt they had as a percentage of GDP, and the world shouldn't bail them out, or the EU shouldn't bail them out. And in this scenario right now, the one reason that we keep getting away from this, I'll say, or
Getting away with it.
With it, I'll say, yeah,
Yeah.
is just that we control the world's reserve currency for now. And I say for now, I think we're safe for a long time. But at some point, if we weren't able to keep printing and have people give us an unlimited supply of paper and ink, this would become a problem. So again, it always bothers me. I joke that this is a great way, like if you get bad news from the doctor, just run up the credit card bills if you don't got to pay them anymore on your way out. But, at some point, this has got to be addressed, right? It just doesn't make sense.
Just a quick reminder, I know we had folks sign in kind of after we'd gotten started. We will keep everyone on mute. If you have a question, please type it into the Q&A box. We'll keep an eye out for questions via the Q&A box. Thanks.
And so now this is actually one of the best slides out there when you talk about the health of the economy. And as Jason mentioned earlier, that basically 68, 69% of our GDP is driven by consumer spending. So consumers are actually in great shape. And even though the consumer balance sheet looks really good, that's really not my focus, but I'll just go over it. In the third quarter of 07, the peak was 85 trillion. After the credit crisis dropped to 74 trillion. Today, about 163 trillion. That's not the biggest part of the story. To me, on the far right, it's the household debt service ratio. And so I'll say that thank you, refinancing. It's just all about interest rates, but fourth quarter of 07, debt payments as a percent of disposable personal income was at 13.2%. And we went basically down with all that wave of refinancing. And everybody kept thinking that we're going to see this curve start moving back up. But the reality is, it went down even further with another round of refinancing. So everybody has also, on the positive, they've gone to 15 and 30-year loans. From back in the old days, people were in 1-year arms, 3-year arms, 5 and 7-year arms. So people are really set up well, and it's really critical.
And to have that certainty, right? Whether you're a business or just a homeowner, right? To know that, hey, I've got this price point locked in, and you can plan accordingly. And that price point is at a very low interest rate. Hey, Alp, we had a question come in kind of on the previous slide, kind of briefly. And I know you sort of touched on this, and I know this is debatable, right? Sort of, but why GDP versus debt is concerning or / important.
Well, so in all my years that I used to, so if you don't know this, in my prior life, I did a lot of tax work. And at one point, only for maybe 5 or 6 years of business accounting, I burned out of that and just did tax work. But I've never known a business or an individual that accrued an enormous amount of debt that didn't end up declaring bankruptcy, right? And so debt service is always a problem. Again, for us, we're getting away with it just because we have the ability to print more money.
And we have plenty of willing borrowers, right?
Well, to some degree, we actually sell the debt to ourselves now.
Yeah,
It's kind of a fascinating development. But so if I just look at it realistically, if you've ever thought about periods in your life that if you had any type of excessive debt and how much pain it brought you, and I'll say many people paid it off the old-fashioned way, just paying things off, but some people got lucky because housing appreciated and they were able to refinance, pull cash out, and pay off the debt. But my point is, debt usually is a problem on the long haul.
And Alp, I know you're going to talk about kind of the impact of rising interest rates, right? But you see this sleeve right here in the total spending, that net interest, represents about 6% of our total budget, right? And if rates go up, the cost of servicing our debt goes up, right? And a bigger portion of our just total spending goes to just paying interest, right? And it's not going to, all the other services and components of our economy.
Yeah, we put out a piece, I think yesterday, and in it we said that if interest rates go up 1%, basically costs the government an extra $290 billion in just the interest on the debt service. So if rates go up 2%, on average, that's $580 billion. So think of how that slide actually changes when it comes to, that's a big bill. And so, and again, I'll point out, it's when you go to the consumer finances slide, I love the example of, so when I graduated college in 1983, I remember I was renting a room out of a house and paying $200 for the room. My dad, who bought his house in 1964, I think his mortgage payment was something like $225, right? And right now, I can't tell you how many times we've been in meetings with clients that have said, oh, our son or daughter has moved to New York, San Fran, Chicago, Boston, whatever, and they're paying more for a one bedroom than the
Their
parents
mortgage
were paying for the
parents.
mortgage, right? So we're actually seeing that revisited. So but the people that have got their homes and have got that 15-30 year low interest rate loan, it's just a really strong positive for the long haul. The consumers should have a fairly long runway of strong consumer spending, on top of the fact that, as everybody knows, nobody spent that much money in the early parts of the pandemic.
All right. Shall we keep rolling here out, talk
Yes,
labor?
sir. So this is powerful, but to be
Mm-hmm.
fair, it's also inflationary. And so if you take a look at the open jobs right now, we're talking about 11 million jobs. And so that's really all I'm going to look at on this slide. And I will say the drawback of that, because we're really struggling to hire people, this is considered inflationary. And so the Feds forever have been trying to get higher inflation. And so this will contribute to giving us higher inflation, because if we're trying to pull people off the sidelines to go to work, wages have gone up, and you'll see that on the next slide.
There you go.
And so basically what we have here is the unemployment rate. You can see on the far right, it has come down dramatically. And you can now see wage inflation on the bottom right part. It was basically just going sideways for years. And every time I would go to a strategist meeting, if you're going to a conference somewhere, everybody was saying they've expected this to kind of move up, and it just went nowhere for basically 10 years. Wages are going up a couple percent. So you weren't seeing anybody, I'll say, enhance their standard of living from wage growth. And so right now we've seen a catch up, and because the job market is, in a sense, so strong that, because there's just so many people, so many job openings, you're seeing people compete for hiring people right now, and wages are going up. And Jason, go ahead. I know what you want to comment on here.
Yeah, even if you go back, right, you can see this huge drop back in the late 70s, and you see they kept bumping up and hitting this trend line, right, and just not breaking through. And so, really going back further than 10 years, there's really been no wage growth, right? In fact, sort of inflation adjusted, there's been, wage decline, deflation. And so not all, I know inflation, and we're going to talk even more about inflation, gets a lot of headlines, and a lot of, people are talking about this as a problem. And not all inflation is the same. Not all inflation is bad. I think Alp and I talk about this a lot, that for the working class, having some wage inflation, not only is that good for them, right, and their household and their ability to pay for life, right, and have a living wage, but as we harken back to the earlier slide, consumer spending makes up such a big portion of our GDP that it's a good thing for the overall economy too, right? If there's more money in more people's pockets, we know they're going to spend it into the economy. That's kind of the point. Is I think we're going to talk about some of the concerns and fears about inflation, but it's not all bad.
And I remember talking to a really well-off client once, and we were talking about wage inflation. And so this person had a lot of investments, and he just sat there and thought about it for a minute. He goes, "Oh, you know what? That's actually good for my investments because they'll be buying from the companies that I own." And he says, "Yeah, it's almost like a win-win situation." It was a really fascinating kind of spin on it. And so obviously the Webster's word for the year might be inflation, right, for 2022. And so what about inflation? And so there's two types of inflation: transitory, and as everybody probably knows, Jay Powell for pretty much all of 2021 said the inflation was transitory, temporary in nature, probably driven by, I'll just call it the pandemic induced supply chain disruption. And I'll add, combined with a lot of stimulus that went into the economy. But so two types: transitory, temporary, or sticky inflation. And the examples of sticky inflation, things like wages and rent, educational expenses for anybody that's paid for college bills. In all my years that, I paid for college, it never went down. And frankly, there was years that if it only went up 3%, you felt like it was a victory. But so certain types of inflation really are sticky, that prices will tend not to come back down. Housing also. So when you throw in just rent, it's just housing prices. And generally that is because when people buy a house, let's say if they pay, $1 million for a house, and then their neighbor sells almost an identical house for 1.3 million, they typically don't want to sell theirs for less than that. So they end up holding off, right? So that's why it ends up being a little stickier. But we have had, just so you know, we have had bear markets in housing where housing prices went down substantially, but not sticky inflation. Commodities, think of like how oil prices, they can spike up, but then they typically come back down more on a supply demand, that if there's excess supply, the prices come back down. Food prices will come down. Autos are an example right now of just something that really is temporary, because the supply chain disruption. Used car prices have gone through the roof. I don't know if you've gone to a car dealership, but I've been to a few car dealerships where there's literally zero, not like three or four, zero new cars. Their lots are filled with used cars. And so they are basically bidding on the cars that are coming off of lease, bidding them up. And supposedly one of the problems there also is people aren't turning in their leases because there's no new cars to buy.
Right. Yeah. I
So
mean,
it's
the
fascinating.
upside down world, dealers are paying more to buy the car back than people originally paid for the car, right? Which is just totally unheard of.
Yeah, and so the whole issue is this like a longer term trend? So is it going to be filled with sticky inflation, and that's going to cause the Feds? One of the ways they fight sticky inflation is by raising interest rates to slow down the economy. And so, if you could buy a house with a 30-year jumbo 3% mortgage, but now that cost 5%, you can't afford as much house, right? So the big differences. So the government will do things to slow down, and so but the big worry is, are we going to have a longer term inflationary period? I've got a friend of mine that actually believes that this is longer term in nature, and this is probably one of the hottest debates out there, whether it's just short term. Again, I personally side on that. I think we'll probably go above normal trend lines for a long time, but I think inflation will subside. And I'll go back to, Jason pointed out on the 20-year history of GDP growth. I mean, the trend line basically is weak, and that's with substantial deficit spending along the way. I just don't see why inflation pressures will break out from that. I know there was a gentleman by the name of Jeremy Grantham who loves quoting that earlier, bull markets are born on quote. He actually thinks that we are going into more of a longer term inflationary period, but this truly is hotly debated. One of my favorite people to read, Ray Dalio, who is the founder of Bridgewater Associates, the world's largest hedge fund. He came out with something this morning that he thinks we'll see some interest rate increases, but he thinks Jay Powell, Federal Reserve Chairman Powell, is going to blink, meaning that he was out yesterday with his notes saying that, good chance 3 or 4 rate hikes over 2022. I actually believe if the market sells off more, if it goes in deeper into, I'll call it correction territory, or somehow goes into a bear market, you'll actually see demand for goods slow up. And Jason and I were talking prior to the call where I was saying, think about it. Like if you're looking to buy a second home right now and you haven't really completely taken the money off to the sidelines, so you've got market exposure with money that you were possibly going to buy a second home with,
Or some other kind of big discretionary, right,
no
kind
question,
of
that
purchase.
even this basically temporarily, just this short, and maybe because we're in the market, we see it every day and people don't look at the numbers as often as we do, but I think this type of action makes people nervous, because you also remember, I'll call it the sell-off during the pandemic, even though it was very short-lived, but everybody remembers the credit crisis and what happened after the tech bubble. And so, I think you'll see some of it just get reined in off of this if the market stays lower for longer. But what's fascinating here also is this pretty much a 40-year trend line of inflation going lower. We've spiked out above it. We've had previous spikes. This one's a little bit of a bigger spike. And so the question is, will it come back down again? And my thoughts are it will. And this
So,
is
so,
probably,
so I know
went
we.
into, go
Oh,
on.
sorry. I know we started with a quote from Sir John Templeton. We're going to close with a quote from Warren Buffett. So we figured we needed to get one more titan of finance in here.
So this is, I've actually had this quote for I'll call it 10 years, when interest rates have just been going down and down, and just said low interest rates are the gift that keeps on giving. And the reason is, we've talked about it, that everybody's refinanced this time to 15 or 30-year loans, and you've literally locked them in. But the issue is, what happens when they take them away, right? So, if mortgages, and it sounds like such a low number, right? If mortgages go to 4.5%, it's almost like, oh, that's just ridiculous, because I'm so used to, you can get a 15-year loan at one point at 2%, and a 30-year loan. Somebody told me they were shopping a 30-year loan maybe 2 months ago, jumbo money at so it was over whatever $600,000-700,000, 600,000 or 700,000, and that was at like 2.25. But he's going to pay a point or two. But anyway, it's just fascinating. So what we're looking at here is the Fed funds rate. So this is what the Feds do to slow down the economy. So you can see, and they cut the rate. So you see on the far left, cutting rates after the tech bubble and the recession there to stimulate the economy again, went up really, really quickly again. And one of the things that's fascinating here to me is, it's like, I just don't understand how they don't learn the lesson to pause a little bit somewhere here, because basically they were up here for just a very short period of time, and then they just immediately cut it again. And so instead of letting it filter in, it generally takes about a year for literally one rate hike to filter through the economy. But what's fascinating here has been this trend line. And one thing that's really interesting is, so after the credit crisis, we flatlined for a long period of time, and we raised rates 9 times. And what almost everybody has forgotten, we actually cut rates twice prior to the pandemic, because the prior administration, the president was commenting over and over again that interest rates were too high in the US compared to the rest of the world. We cut a 1/4 point and a 1/2 point prior to, so we actually backed off, raised nine 1/4 point hikes. We basically took away a third of it. And I don't think they were actually done, but they were kind of just possibly going to go a little bit more to just keep the economy growing as best as possible. But if you look at this trend line, we keep setting lower highs on it. And so when people talk about that 4% Fed funds rate, it would be a reversal of this trend line. And again, I don't see it. Again, it just means that if we have some crazy inflation, it could happen. But I love trend lines, and I could see us at some point when you're low. I tend to think, obviously, the trend line has to shift, and we'll probably bounce along the bottom longer. So this is interest rates and inflation. So this is the nominal and real 10-year treasury yields. Again, from the middle of the page to the right, a 40-year trend line lower. And so the top line basically is the actual 10-year treasury as December 31st. We're now spiked up to about 1.7 something, 1.8. December 31st, 1.51. Inflation adjusted, if you were buying that because inflation had spiked up, you were actually locking in a loss, meaning that if you were sitting in cash, and in this case, a 10-year treasury, when you factor in inflation, the money in the bank, while it doesn't go down during a correction or a bear market, in theory, it was losing out to inflation. But again, our thoughts are is that we see this more bouncing along the bottom here for a while. And to kind of give you a little insight about the rest of the world, I will say that you actually, when our numbers are down here for the 10-year, the rest of the world, it's still really cheap. You can get the German, the 30-year German government bond, I think, is basically flatlining around 0. And you see that in Japan. So a lot of the world has just got super low interest rates. And so that was always, I think, the President Trump's issue of like, while we were raising when the rest of the world wasn't, it wasn't a thing that we needed to do. But so what we see here is also something that's been talked about a lot lately. I know we had a question on this: cycles of U.S. equity outperformance. So if you go to the far right, U.S. markets have crushed the international markets for a long time. And you can see there's various periods where the international markets have outperformed, but 2 of the last 3 bigger cycles have been the U.S. markets outperforming. And again, I know one of the questions, what are the thoughts on international equities? we've said this for a while. Our expectation is that the international markets will play catch up at some point. I think one of the things that has really driven this outperformance has been our tech companies, which literally have dominated the world. The Microsofts, the world, the Amazons. I think we've just had better tech. And if you look at the tech companies that come out of Europe, there's literally only been a handful of them. It's just been so dominated, and tech has been just a bigger theme for the last 20 years. But yeah, so our thoughts are that we would see international lead for a while. But we've made a joke many times with individuals like, the international markets, it's somewhat been like Walmart pricing, where it just has stayed low.
For a long time. But one of the things that do make some of the international markets attractive
It absolutely is just the valuations and also the dividend yields. And so this is basically the price to earnings discount. So, the higher the PE ratio, once again, the more expensive the market is. So international markets are currently, if you see on this, on the left side, on the right side of the left side, basically in the middle of the page, on December 31st, basically selling about a 32% discount in terms of PE. But the average for the past 20 years has been a discount of about 13%. So you can see a fairly big decline. So doesn't really make sense for it to have shifted that much. One would argue that we should see more dollars shifting. And if you look inside target date funds that are probably one of the biggest investments inside 401ks now, most of those are holding anywhere from 35 to 42, 43% international exposure in those. And their belief is that over the next 10 years, you should see them give us a larger portion of the returns that we'll see overall in portfolios. Also very interesting, which we think is really great for retirees, dividend yields overseas substantially higher.
Yeah.
So you can actually see just.
I know we're running along a little bit here, so we'll pick up the pace, but I just want to, we find this really interesting, right, as we're kind of thinking about, sort of looking globally and what's going on in the world. But this slide looks at global climate mitigation efforts as an area where policymakers globally are converging on reducing emissions, right? So on the left-hand chart, you can see comparing the US with the European Union, both aiming to be net zero in carbon emissions by 2050, China by 2060, of course, starting from different starting points there. But therefore, they will need to continue to invest in renewables, right? And you'll see that on the right-hand part, and reduce reliance on fossil fuels. And we talked about trend lines. You may notice some trend lines there, even before the forecast component of it, right? It's been a while that our dependence on oil was already declining, and for a variety of reasons. And so you see that the renewable spike up there, and I know that's been a common conversation with on our investment committee and with a lot of clients, thinking about sort of that new world of investment opportunities, both in terms of just being opportunistic, but also just realistic.
Very popular topic of discussion.
Yep. And this slide looks at the structural case for investing in emerging market assets, right? So Alp talked sort of international, broadly speaking, now sort of narrowing in on emerging markets. And one component that isn't on this slide, but Alp talking about sort of the U.S. is dominated sort of in the tech names, right? Certainly relative to Europe, really sort of the only other parts of the world that have shown some competitiveness, if you will, in sort of the tech space is the emerging markets, right? China certainly being sort of at the front of the pack there. But what this slide is really kind of focused on is the growth of the middle class, right? And we can see that just in the last 20 years, the middle class has grown tremendously in size, and this story is set to continue over the next decade as well, especially in countries like India and China. We see this as an opportunity for global and local companies to then tap into these new consumers, right? And so just like in the U.S., GDP is driven so much by consumers, you're starting to see that shift in GDP growth in a lot of other countries. And so now kind of shifting gears a little bit away from sort of the specific markets to just sort of a comparison. Many of you may be familiar with this. We always enjoy looking at this chart. So this is a chart of historical performance and volatility of various asset classes, right? As well as an annually rebalanced asset allocation portfolio there in the middle. That's what the kind of the line is following, sort of I'll call it sort of a generic sort of 60-40 balanced portfolio. The asset allocation portfolio incorporates the various asset classes shown in the chart and highlights that balance and diversification, right? Kind of the goal there isn't necessarily to try to nail it every year, right? But it's also to try to avoid the bottom, right? And try to, get that the best possible mix of returns at the right risk level, right? And I always think this is a great chart to just sort of, again, remind ourselves that for the most part, most investors, especially I think for folks that are going into retirement, that's what you're sort of aiming for, right?
Jason, on the slide, one of our questions was outlook on precious metals.
Precious metals and commodities. Yep.
I think one of the things to point out, which is really fascinating, the bottom part of that screen there, basically you can see the green with commodities on the bottom, worst performing asset class for pretty much a decade. And despite a lot of people saying that we're going to go into what's called like a commodity super cycle for the last decade, and now people are still repeating that, and it's getting a little bit more traction right now. So commodities did well last year. Again, think of the supply chain disruption. So the question is, what's going to happen when the supply chain recovers? And we know that could still be a long time before it fully recovers. So commodity prices will do well for a while. But the question is, do we still have plenty of supply of commodity? And, I would argue that we do. But others have different points of view on it. But you can see last year, commodities did 27%. And year to date this year, I know it's only a month, commodities are up 6.5%, but everything else is down. Negative for the year.
And I think this is also a great reminder, right? We were just sort of highlighting what we see as opportunities in emerging markets, but recognizing, look, emerging markets is one of these most volatile asset classes, right? Wild swings. Rarely is it kind of in the middle. So let's, we just got a handful of minutes here out.
Yep. So basically, Biden's Build Back Better Act, probably difficult to pass it in its current structure. I know there's a big debate if they were add even more stimulus, would it be inflationary? And I know the administration has come out with some information arguing that the plan would not be inflationary, and they've got it backed by some Nobel laureates. Others have argued that that's just impossible, considering you'd be throwing stimulus on top of it. Our view is it's going to be difficult to get it through the way it is, especially going into midterms. But I'll end it there for time. And then Jason, back to you for risk profile.
Yeah. So again, probably right. The most important theme and that is forever, right? Is timeless. Is the two components for any portfolio, any investor, making sure that you revisit and constantly consider your risk profile, right? Is your portfolio in alignment with your tolerance for risk, the need that you need to take? How much risk do you need to take, and what's your capacity for risk, right? There's a lot of components that go into that. So certainly reach out to us if you want to have a conversation to think about, hey, am I in alignment with my needs and capacity for risk and my tolerance for risk? And then the other piece to that is my portfolio built, is it appropriately designed for my time horizon, right? Is this an account that is money that truly is really long term, right? Is this an account that is money that I'm going to expect to need in some period of time? And sometimes it's a blend, right? And so making sure that within an account or within a portfolio, you're allocating it appropriately based on time horizon, risk profile.
And a time horizon could actually span to the next generation, where somebody will say, oh, I've got a really strong pension and a lot of excess money, and so I'm looking at this money as generational now because I know I'm not going to spend it. And so that's a different way of thinking of things at times.
Yeah. And I'm going to skip this. This chart is just kind of representative of the importance of thinking about the time frame in your investments. We'll wrap it up here. And I know we had a couple questions sort of related. I'll throw these out here while we wrap it up.
Let me just do a quick 1 minute on this. So tailwinds turn into headwinds, and what we mean there, that for literally the entire post-pandemic recovery, with all the stimulus money we had, both fiscal policy, monetary policy, all pushing us from behind, like a strong tailwind. Now we're running into headwinds for the first time in a long time. We've talked about the supply chain. It's going to take time to recover, but it is recovering. I read an article maybe 3 or 4 weeks ago that Toyota said they were going to be able to produce 800,000 cars in the month of January, which will be like a historic high for them. We've talked about too much stimulus, but I want to make a point that some of the stimulus went into hands that absolutely needed it, and so we're not making a case against giving stimulus out. Our point is plenty of people that never missed a paycheck and plenty of businesses that ended up barely being affected by the pandemic received a lot of stimulus dollars, probably well over $1 trillion. And so that was too much and that was inflationary. We've talked about the transitory to sticky. Rising rates, it's probably going to happen, but I'll make the comment. I kind of side with Ray Dalio. I'm not confident it's really necessary. And Powell was trying to hold off on that forever. He actually was calling it transitory forever because he thinks at some point I believe when the supply chain gets remedied, we'll see it pull back. But it's just a question of where that fits. And we've already talked about the correction that we're basically in now and that stealth bear market.
So Alp, let's kind of wrap up here with any kind of specific moves, right? Whether it be at sort of the micro level or just sort of macro overall that kind of we at AFS, so recapping some of the things that we've been talking about, some of the moves that we're considering in client portfolios.
Things that we have actually done is primarily de-emphasize some of the large cap growth names. We had a couple of funds that we knew it all along, but we call it hidden exposure. It was a fund, like an emerging markets fund that had some large cap growth that sold into emerging markets. So we moved to more pure play. And on the S&P 500, love the fund, love the low cost nature of it, but because it's top heavy right now with a lot of exposure to those large cap growth names, we kind of moved more on a temporary basis inside retirement accounts to a fund that de-emphasizes that a little bit. So, we're debating a lot right now, as you would guess. And I think the team probably gets tired of my emails in the middle of the night as I watch a lot of the shows like Bloomberg at 12 o'clock at night, watching the international markets. But obviously a lot going on right now, and we'll keep you posted on those moves. Well, you get put to our final quote, Jason, if you want to say something, but they can read our favorite Warren Buffett's quote.
Yeah, let folks read there. I was just going to say, we've been, we have an investment committee team. We're having, daily, multiple times a day conversations, right? And I think one of the most important things is, right, it's to have that debate, right? To have that conversation, and it doesn't always necessarily, the right thing isn't always just to do something, right? And sometimes it is, sometimes it isn't, right? And so right now, if I were to kind of recap what Alp was sharing, I think where we are is, we are making some adjustments, right? But it's nothing radical. We don't think right now is the time for putting it all under the mattress, or right, that sort of thing. And I'll come back to the earlier comment. And it's dependent. It's client dependent. It's account dependent. What's the goal for this money? What's the time frame for this money? What's the overall risk profile for someone's portfolio?
At times, there's some easier trades to make. And I just want to make sure we go through all the questions.
Yep. Yeah, I wanted to address here. Maybe you're going to do the same one. I think the only one that we haven't touched on is a specific question around savings bonds.
Let me back up. So I had one from our Alaska friend. So with inflation, interest rates poised to rise, what is the strategy for managing fixed assets, bonds, money market CDs? So I actually had a call with Fidelity fixed income strategist yesterday. They actually think 4 rate hikes are already priced in to the fixed income market. So surprisingly, they were actually making moves on that. And they think inflation will subside by the end of the year. They think you should see, as you know, we had, I think, a year over year print of over 7% on inflation. They think that number will be 2.6% by the end of the year over year one. So it'll be probably 3-something% total for the year. So they already think a lot of it's priced in. So that's an interesting comment. So that means not many moves there for now. Supply interest rate forecast and supply chain impact on housing. I will say the housing market's been tight for a long period of time. They've underbuilt literally for 10 years. So I think that it's probably going to be tough to find reasonable housing, apartments, etc. I think will be difficult. Rents will be up for foreseeable future. I just know, like in downtown Bethesda, even though they built a decent amount, it's still nowhere near the cranes they would have had 10 or 15 years ago in the sky. Or savings bonds, a good investment. Typically not. I know there is that one that did come out, and it's escaping me. Jason, you remember what it was? That's a $10,000 limit, but you
I
have to
know.
go to Treasury Direct to buy it.
Yes. Yep. Yeah. You have to do that. Each person, essentially, each Social Security number is limited to $10,000. But if somebody's looking to get I think they're yielding around 6-7%. Especially if you have kids, right? That get an account there. But generally speaking, savings bonds have not been great investments.
And so the last question from our good friend, I'm not going to mention that, which is likely Fed interest rate increases on stock market returns. Yeah, I think you can actually see that right now, that the market gets nervous. And it's not about the interest rate increases as much as it is about the uncertainty on the number of them, because the forecasts are all over the place. If everybody was saying, okay, we're going to go up 3 or 4 times, and we're pretty confident we're going to pause, and that's probably all we have to do, it's done, and we'll adjust a little bit from there, I think the market would have settled very quickly. Again, we still would have a correction, but as we say, I think the corrections, when you look at that quote in front of you, that's where when people like Warren Buffett are actually coming off the sidelines. To give you a reminder, Warren Buffett's company, Berkshire Hathaway, sitting on over $150 billion in cash. He's been building up to try to get better pricing. And what's interesting, the type of companies that he buys, they're still not down that much. Like they'll call it the more blue chip dividend oriented companies. They're really not that beat up. You've seen some minor pullback in large cap growth, but some of those names went up 50 or 60% last year. So I don't think we're anywhere near Buffett bargain territory yet.
So thank you, everybody. Please feel free, if you have additional questions, to reach out to us. If you'd like to set up a time to chat, happy to do that as well. I know we ran over a little bit, but appreciate you sticking with us. And we will be sending out a follow-up with the recording. And stay safe, stay warm.
And and I'll say for that nice comment, I'll say AM, the initials. Thank you so much. Talk to you soon.
All right. Take care, everyone.
See you. Take care. Bye.